So here we are at episode 3 of Industry, and we're going to take a look in some more detail about some of the jargon they use and some of the situations that they get themselves in, and really just understand whether this is a true reflection of what's going on in investment banking or not. So let's take a look.
I want to bang the drum this morning. Rishi and the traders will be in shortly with their axes, double sales credits to anyone who fills them this month. Our world view today.
Now here they're talking about sales credits, and this is a mechanism whereby the salespeople who are selling the securities to the investment managers will get points or credits for each trade they do. So it's often not actually a direct commission, it's more just kind of points they get for doing certain activities and certain things. And they'd be called credits or points. And that, of course, is going to influence what their total compensation is going to be at the end of the quarter or the end of the year.
Is what we own and what our traders own.
Is there any more color on Phelim's departure?
Well, he's been having trouble with trading lines and some protracted legal issues.
Here they're talking about trading lines. Now, generally speaking, if you're a trader, you will have a kind of limit, an exposure limit that you will be able to trade up to. And those are very, very tightly controlled. So you'll be able to trade certain sizes within that limit. But in addition to that, the clients of the investment banks and the investment managers will be given a trading line as well, so that they can trade up to a certain size. The reason that this is important is that trades can go wrong and you have what we call settlement risk. And settlement risk is where one side of the trading party doesn't fulfill the trade. And of course, as prices move all the time, it could mean that the price has dropped or risen against you after the trade you think has been closed. But if the other party doesn't perform on the trade, you're in trouble because you will take a loss. And that is known as settlement risk. So that is why there are restrictions in the size of the trades that both the clients of the investment bank can do and also the traders on the trading floor. And that's a way of kind of controlling risk.
We need to be sharper at packaging trading strategies across asset classes. High margin, multi-asset plays, please.
So within the financial markets, the securities are split up into asset classes, and there can be really big groupings like, say, equities, which are stocks, versus fixed income, which will be bonds. But within that, there will be kind of subgroupings. So for example, high yield is a subgrouping of fixed income, and govies or government bonds is another subgrouping, but within fixed income. So with equities, you will have a breakdown of that asset class into sub-asset classes like, say, emerging markets or Western Europe or Americas. And so although you have broad asset classes, you can actually segment them into different sections. And you'll often find that certain traders will specialize within a certain sub-asset class.
Our guys don't have conviction. It's because we're not being convincing. Simple as that.
Morning, kids. Eric. Sarah. So, we've got some mid-market offers on some corporate bonds. I would love them to be moved this morning.
Now here they're talking about the mid-market price. And the mid-market price is the price in between the bid and the ask price. Now, the bid and the ask price are two prices that the investment bank will quote to people. And the reason they're quoting two prices is that an investment bank is a market maker in securities. And this means that they will either buy from you or sell from you. So if they're buying from you, they will bid you a price. And what that means is they will typically want a lower price if they're buying from you. But if they're going to sell to you, that is the ask price. And they will also ask you for a higher price for the ask price. So this means that the two different prices of the bid and the ask, the lower price, the bid price, what they'll buy from you, versus the ask, which is what they'll sell to you at, is known as the spread. And that's effectively the trader's profit margin. Now, the mid-market price is slap bang in the middle of those two prices. And that kind of gives you an indication of where the market is. But generally, when the traders quote prices, they'll quote you two prices, the bid and the ask. The bid, standing for B, what they'll buy at. The ask is what they will sell to you for. And of course, they will sell to you at a higher price than they will buy from you. And that is their margin or the spread. And that's why, of course, having a great amount of flow in a security is really important, because that means you will get more of the spread between your bid and ask prices in your trading book.
I know this might sound crazy, but I think that we could play another slowdown in housing.
And why should I listen to a grad?
The housing market's a canary in the coal mine.
You don't say canary in a coal mine. You sound like a fucking financial journalist. What's the play?
Well, obviously gold, maybe a call option.
That's vanilla. Work on a pitch, and we'll talk later.
Yeah, thank you.
So here they're talking about gold being a call option. We'll talk about call options later on. But they're also talking about something being vanilla. Now that's similar to the ice cream. If you go into an ice cream store, there'll be a myriad of different types of flavors. But the basic flavor is the vanilla ice cream. So anything that is described as vanilla in the financial markets is a very basic, simple security without any bells and whistles on it.
This guy Usman actually runs money. I'll ping him an intro. What's their mandate?
Now here Gus is talking about the investor or the asset manager or an investment manager's mandate. Now what is the mandate? Effectively, every asset manager has a set of instructions which are laid down typically at the beginning of when the fund is created. And they will say, broadly speaking, what kind of assets you're allowed to invest the fund in and how that money should be invested. And also it will drive the kind of, it's essentially the rules of the game for the asset manager. And of course, if you are the sales side of the trade, you really want to understand what the mandate is for that particular asset manager, because it will allow you to understand what kind of securities they're going to be interested in trading in. Because, for example, some funds will be very, very conservative and they'll only invest in very safe securities. Other funds will be much more focused on higher yielding but more risky securities. And that's a really important thing to understand as a salesperson when you're dealing with that particular client.
All right, bitch.
Someone should tell her they're monetized.
Yep.
Yeah.
Now this is interesting. This is where, in this case, Harper has got a message. It looks like the Bloomberg platform messaging, which is very, very frequently used on trading floors. And they're talking about someone should tell them that the messages are tracked. And that's absolutely true. In fact, everything is tracked on the trading floor. Phone calls, messages, emails, absolutely everything. And in most large trading floors, you would be expected to put your personal mobile phone in a locker outside the trading floor. And this is really to protect the institution, to make sure that there are no insider trading and they can track everything and get all the detail, any trades or any discussions with investors. So it's super important to understand that when you work in a bank, because everything is tracked. In fact, I've been teaching on training programs where people have been Googling or going to sites on the web that they really shouldn't be going on, and that has been picked up by compliance, and someone walks into the room and say, we need to talk to X because they have been going to sites that they shouldn't have been. And that's actually was in an IBD class, an investment banking class, not even a sales and trading class. So everything is tracked in huge amounts of detail. So in this case, Harper is in a taxi going to a dinner party and she's working hard on a laptop for doing the report. And she's getting messages from both her friend because she's late for the dinner, and also she's getting messages from Daria because she wants the report. That is a classic situation that you will find yourself if you work in an investment bank, where you are just competing demands between your social life versus the needs of the business. And in some cases, particularly in investment banking, that can be a real problem, because actually you can be working late most evenings and you'll be working in the office probably at least one day on the weekend. So it is a little bit of a difficult dilemma to handle. And The only thing that really makes it worth it is the money, because you get paid very, very well in these jobs.
Home builders' stocks are looking a little toppy.
That's not a house view.
The house view's consensual.
Counter consensus is
Now here they're talking about consensus. Now the consensus typically is the average market view. And if you're talking, for example, an individual stock and the forecast of that stock's earnings, then the consensus estimates will be the median forecast for that company's earnings. However, the market also will look at lots of different data types, and they'll have consensus estimates about things like where the currency is going to go, where housing starts are going to go, where employment numbers are going to go. And the consensus number is the average of the market. And sometimes the house or that particular investment bank, in this case Peerpoint, will have a different view from consensus. And that can be very valuable if it turns out to be true. And the more correct you are, particularly for non-consensual views, the much more valuable you will be to your investment management clients. And that is a very important aspect of you as a salesperson, to make sure that you can get views that are non-consensual, that of course have to be right. If they're not right, then that's a disaster, because it means they will potentially lose money. But if you can get non-consensus views that are correct, that is gold dust for salespeople.
where we live. Keep talking.
Initially, I was thinking some puts on the S&P, maybe linked to a call on gold.
Now here, Harper is talking about puts and calls. Now, these are what we call options. Let me explain how an option works. Imagine you are taking out car insurance. You pay a premium, and that will give you coverage in case you have an accident. And if you have an accident, that means the insurance company will pay you out some money to cover all the relative costs of the accident, your healthcare costs, fixing the car, etc. An option works in not a dissimilar way. What happens is you pay a fee, and if a stock goes above or below a certain level, you will make money or lose money. Now, a put option is an option that allows you to sell a security at a fixed price. Now, you have to pay for that opportunity, and that's the initial premium. So if you buy a put option, what that means is that you can sell the security at a fixed price. Now, you don't actually have to own the security. You can completely speculate that the price of the security will fall, and that means you can go and exercise the put option, and that will allow you to sell the security at a higher price. Now, of course, you go and buy it in the market at the lower price if it's fallen, and then you can satisfy the option. Now, some options can be cash settled, so they'll just give you the difference between the put option price that you can sell at versus the market price of the stock. So a put option is where you pay a fee that allows you to sell a security at a fixed price in the future. A call option, on the other hand, is very similar. You pay a fee, but that gives you the right to buy the security at a fixed price in the future. Now, with a call option, because the purchase price is fixed, ideally you want the underlying security to go up in value. So this means you can exercise the call option to buy the security, let's say at 100, but if the market price is at 120, it means that you can immediately sell it in the market for 20 extra or 20 higher. So these are mechanisms that allow you to speculate on the one hand, if you think prices are going to go down or up in the future, but they also, and they were probably initially designed to provide hedging purposes. So for example, let's say you own a security and you're worried about the price falling. What you can do is you can buy a put option that allows you to sell at a fixed price. So even if the security falls and you lose money on your ownership of the security, you will make money on the put option. And that's known as a hedge, where you have two securities that effectively move in opposite directions.
The product I have the traders looking at includes a put option on the Home Builders Index and a call option on gold, and a sweet kicker credit default swaps on the Home Builders too. It's the ultimate hedge in a tidy suite for client convenience at margins big enough to pay us while they own it.
Now, in this case, what Harper's talking about would be really termed a structured product, where you're kind of adding 2 or 3 securities together to have a particular view. And it doesn't really sound too much like a hedge to me. So what she is thinking is that the home builders are overvalued. And what that means is that she expects the value of those home builders to decline, the prices of those stocks. Now, that is why she is suggesting buying a put option on the home builders, because what it means is that if you own those home builders, or you own the put option, and the price of the home builders declines, it means you can still sell at the higher price, the put option. So that means you would make money if the home builders declined in value. But then she's also saying, well, actually what we should do is buy a call option on gold. Now, generally speaking, gold increases in price when you have market distress, because people run for something they feel is very, very, very safe. So if you had a meltdown in the home builders and there was market stress, then the gold price would rise. Now, if you have a call option on the gold price, it means you can buy gold at a fixed price. And if the price of gold rises above that, you will make money. So this isn't a hedge. This is actually just increasing your exposure to this story, because you're making money if the house builders decline in price from the put option. And then you're also making money if the gold rises in price because of the overall meltdown from your call option. Now, in addition to this, she's then saying, well, hey, how about a credit default swap? Now, a credit default swap is effectively just like insurance. Credit is a term for debt and loans. And generally speaking, if you make a loan to somebody, either by buying one of their bonds, or if you're a bank and making a loan, the biggest thing that you're worried about is default risk. And that means not having your interest or principal paid on time, or in some cases, not at all. What you can do is you can buy something called a credit default swap. And that effectively is where you are swapping the risk of their default. So in other words, if they default, then the credit default swap will pay out. And typically you will pay a fee for that. Now, Harper is talking about this insurance, this credit risk insurance on the house builders. And she's saying buy the credit default swap, because if the house builders default, that will pay out. So this is nothing like a hedge. This is just massive exposure on top of exposure on top of exposure. If it all wins, if it all turns out correct, what will happen? The prices of the house builders will decline. That means you'll get a payout on the put option that you bought. In the resulting meltdown, the gold price will rise. You'll get a payout on the call option of gold. And because the house builders are melting down, they will default on any bonds or loans they have, and your credit default swap will pay out. Now, of course, if this doesn't happen and the house builders rally, you're not going to get anything out of the call option, which means you've lost your premium. And it's unlikely people will run to gold, so you'll lose the premium on the call option on gold. And they won't default, so you'll lose the premium on the credit default swap. So this is nothing like a hedge. This is massively risky, and it's in the world of structured products. So this is really unrealistic to have happen as a pitched idea, because literally it's just massively increasing your exposure. But it gets all those terminology out there.
Those spreads are going to be wide enough to drive the bus through.
That's our bread and butter.
We get paid.
So here they're talking about spreads wide enough to drive a bus through. Now the spread is known as the bid and ask. So the greater the difference between the price that you will buy the security at, which is lower, than the price that you will sell the security at, which is the asking price, which is going to be higher, the more money the trader will make. And it's often in these structured products that they tend to have the widest margins, because they are traded less, they're less competitive, there's less people offering them. So this is why they're talking about a very wide spread, and the term is often used in finance that you can drive a bus through that spread.
So I've had some thoughts about how you're positioned.
You know me, Daria, I wouldn't know the sky was blue if you didn't bring me a colour chart.
Do you have any tail risk hedges on?
Now, in this situation, they are talking to the fund manager. And Daria is talking about the position of the fund manager. And that will be their overall ownership of the collection of the securities at that particular time. And it's really important for the salespeople to know that, because again, if they have a view about particular security increasing or decreasing price, they can pitch that idea to the investor who has a position in the securities. Now, what Harper is mentioning here is tail risk. Now, in finance, a very important concept, and in mathematics, is something called a normal distribution, or more commonly understood as the bell curve. Now, the bell curve is, imagine you put all a population in order of their height, and then you kind of grouped the people at different heights into buckets. What you will end up, if you graph that, is a bell curve, where the bulk of the population are in the middle of the height chart, and then as you get to lower heights and higher heights, then the amount of people at those heights kind of tail off, and it gets smaller and smaller and smaller. Now, often stocks trade in a very, very similar way to this kind of bell curve or normal distribution, and many things in life do. However, securities, particularly in times of market stress, can actually diverge away from this pattern of trading of a normal distribution. And essentially what that means is that the tails of the bell curve kind of rise, or sometimes they're known as fatty tails. And often the bit in the middle of the bell curve kind of decreases. In other words, the risk of the securities trading at much lower or much higher prices rises. Now, this is known as tail risk, and this is what Harper's talking about. And she's saying, have you hedged your tail risk? Effectively, what that means is, have you kind of bought insurance that will protect you in case the prices of the securities go at a much more volatile level, at much higher levels and much lower levels than you would expect, and therefore create the potential for you to lose money. So that's what she's talking about here. I would say generally, I mean, Harper seems super smart, but if she's an intern, there's simply no way that she would be talking to clients like that at all. She would really be sitting on the desk or giving her projects, but there's just no way that she would be pitching ideas to clients. That's just massively unrealistic. But of course, it makes good drama.
Harper, hello?
Hi, Aubrey, it's Harper from Pierpoint.
Yeah, what can I do for you?
It's 2 greens.
Eric asked me to call you. I have an interesting counter to your current exposure. The analysts think that equities will continue to rally, but I think that there's some risk in that view. I think that housing is rolling over.
So what are you offering me?
It's a combination of puts, calls, and CDS packaged in an elegant, cheap suite.
No, I don't trade CDS.
Why?
I don't trade products I don't understand.
Well, these are packaged in a digestible way. You don't need to understand the product just to pay out.
No, incorrect. From tulip bulbs to CDOs, newness has always been a dangerous sign. I'm not one of those market participants who trades in the dark.
Trust me, these products aren't new.
Unfortunately, I only trust myself, but I almost trust Daria up to 3 full years. Is there anything else? Harper.
Yeah, Aubrey, while I have you on the phone, do you want to do that cable idea that Daria was talking about at the meet?
Sure, that's transparent enough for me. Make me a price in $50.
20, 30?
30. $50.
Okay, so just to confirm, you're 50 at 30.
Yeah, I'm in a bit of a hurry, but that sounds great. Thanks for your time.
So firstly, you can see here that Daria is talking to the investment manager, and she's pitching her same idea as this structured product. There's simply no way that that would be thrown together so quickly. You'd need it to be modeled. You'll need a clear payout diagram. So it would be something that would be really carefully structured. So that's the first issue. The second issue, there's simply no way that as a new analyst or even an intern, as it looks like, that she will be pitching this to clients. But it makes good TV. Now, the idea that Daria also gave the investor, which was that the dollar is going to increase in value. So this means that what they're saying is that buy dollars now, and then you'll get a payout because the dollar will increase in value. So here we have the pricing screen for cable, which is the price between US dollars and British pounds. And it's typically quoted, so the price of £1 in US dollars. And you can see at the top it has got $1.32. Now that's the base price. But of course, because there are millions and millions of dollars and pounds changing hands, actually the bid-ask spread is in decimals to that. So in this case, you can see it's got the buy GBP. So buy Great British Pounds and sell Great British Pounds. So if the client wants to buy Great British Pounds, that is effectively the ask price that the bank is offering. So the ask price is 132.28. That's what they're willing to sell British pounds at. And what they're willing to buy British pounds at is $1.32.18, which is their bid price. Now, interestingly, Dara's overall idea was that in this case, the client should buy dollars. So here, Harper is making a terrible mistake because this is actually buying pounds rather than buying dollars. The other issue here is that she's talking about $50 at 30. Now, there's no 30 on this screen, so that seems a little bit random. I don't know why they said 50 at 30, because what that should means is that buy price should be 30 rather than 28. But I guess maybe she's making a bit of money on that. But the big mistake that she's making is that she is executing the purchase of pounds for dollars rather than the other way around, which is not what the idea was and certainly not what the client expects. But the 50 is 50 million. So when people talk about 50, they're talking in millions. And you can start to see why the job becomes so stressful, because you're not dealing in small amounts here, you're dealing in massive amounts, and that can make a huge impact when you are making mistakes, that you potentially will lose a lot of money.
I mean, since Google went public in 04, earnings are up 100-fold and price is up 10-fold.
Yeah, see, that's real underlying business change.
Now here they're talking about stock pricing here, and they're talking about Google's growth in its earnings and growth in its price. Now, generally speaking, stocks, certainly fairly mature stocks, will trade on a multiple of their earnings. So if a stock has earnings per each share of, say, $1 and its price is $20, that is a price to earnings ratio of 20 times. Now, generally speaking, the Standard & Poor's 500, the 500 largest quoted companies in the US, on average, the price to earnings ratio is around about 17 times. Now, sometimes it's higher and sometimes it's lower, depending on what the market is happening. And that really depends on people's risk appetites. When they have a lot of risk appetite, what tends to happen, the overall valuation multiples start to rise. In other words, people are prepared to pay a lot more for the same earnings stream. And if the risk appetite contracts, you'll generally find that prices decline, so investors will pay a lot less for the same earnings stream. Now, other than the overall market and people's risk perceptions, obviously the thing that is going to grow a company's stock price is their growth in earnings. And so generally speaking, we would normally expect to see, certainly for mature businesses, as they grow earnings, their stock price to also grow, assuming that the price earnings multiple doesn't change and there's no overall change in the markets. And this is what they're talking about here, is that if Google's earnings are growing at 100 times, but its price is only growing at 10 times, it effectively means the stock is getting cheaper and cheaper and cheaper because the earnings are growing at a much faster rate than the price. The price is effectively not keeping up. Now, in certain situations, that often is because the growth in the earnings is declining over time. But this certainly could mean that this would be a buying opportunity because the price is not keeping up with the growth in the earnings of Google. So that is Industry Series 3. There's not masses to say here other than the call options and put options and the bid-ask spread and also Harper's trade that she got wrong, which we will see in episode 4 what happens as a consequence of that. But it's very interesting. The one overall thing I would definitely say is that certainly the analysts in question, they've got way more kind of responsibility, particularly on the trading floor, than they ever would have. And we're also seeing Gus has been moved from IBD to the trading floor. So it was a little kind of confusing at the end of the last episode because it kind of sounds like the trading floor and IBD are really one and the same, and people are moving between IBD and the trading floor where they're rationalizing desks. That's very misleading. They're two almost not completely separate, but they're two divisionally separate businesses. You have IBD that are going to advise corporate clients. You have the sales and trading operation, which is going to interface with investor clients. And it's likely that if Gus was seeing his team disbanded, he would go into another IBD team, another industry team, or an execution team, or debt capital markets or equity capital markets. Anyhow, let's see what happens in episode 4.